Life insurance policies are financial agreements that provide money to beneficiaries after the policyholder's death. They help protect families from financial hardship by covering funeral costs, debts, living expenses, and future needs such as education or mortgage payments. Common types include term life insurance, which offers coverage for a set period.
Life insurance claim may be denied. You know, the death of a loved one is a difficult time, and most people buy life insurance to replace the income that is gone once someone leaves this earth. Now, once a life insurance policy is purchased, many think that they've solved this financial problem. But the purchase of a policy doesn't necessarily guarantee that the death benefit will be paid. Insurers examine the terms of the policies carefully before paying claims. Now, here are some common reasons that the proceeds from a policy aren't paid to the beneficiaries.
Every day her husband was in the hospital and rehab, Kathy Walsh took meticulous notes in her journal.
He was there for maybe a month and a half.
Her 79-year-old husband, Bill Walsh, fell on the stairs at their Gwinnett County home and after a multi-day stay at the hospital was transferred to Cambridge Acute Care Center to recover from multiple broken bones.
He was in that rehab facility because of his injuries.
Yes. Oh, yeah. Yeah. They wouldn't send him home.
But her husband's death certificate says nothing about the fall or those injuries. There are lines for that: date of injury, place of injury, describe the injury, all left blank.
He had pneumonia at the end. That's not on there.
Instead, the official record of his death, signed by Dr. Sam Ghaffari, lists cardiac arrest, Parkinson's disease, and dementia. But Walsh did not have Parkinson's. His wife has paperwork to prove it. And he was not in the rehab facility for heart trouble, but because of his fall. Still, it's listed as a natural death, not accidental.
I wish it had been natural causes. I wish he had died at home in bed. He didn't. He suffered.
Data shows Walsh is far from alone dealing with an incorrect death certificate. 85% of the death certificates they examined had errors. 53% of those were classified as either major mistakes or wrong or missing causes of death.
It happens all the time on government documents.
Attorney Maggie Randall says each word on those official government documents is critically important when dealing with insurance companies and estates.
Doctors should pay attention too, because these words matter.
The Walshes have a $100,000 accidental death insurance policy that won't pay because of what's written on that death certificate.
It's called the incontestability clause. Now, this allows the insurer to deny paying a claim if the insurer finds the applicant made misstatements on the application and subsequently died. Now, the period for dealing with these misstatements is usually 2 years. However, if the applicant deliberately tried to defraud the company, there is essentially no time limit to contest the policy benefits.
The hardest part of the last few years for Mitch Gilbert,
give me a hug, come on, bring it in,
is when his dad's stories stopped and dementia set in.
He can't, feed himself, he can't bathe himself, he can't go to the bathroom, he can't dress himself.
Mitch has now taken over his dad's care, and he manages his dad's finances.
He needs help. He doesn't have a lot of money. He really has no money left.
See, Mitch has been fighting a battle for quite a while now over this, an insurance policy he found in his dad's record.
He bought a policy called Catastrophe Major Medical Plan.
Is a provision, $300 a week for convalescent care. $300 a week certainly wouldn't come close to covering the cost of living that memory care in today's dollars, but it would help. So Mitch filed a claim.
They denied the claim.
He figured the insurance company was just playing hardball, so he decided to as well. Hired an attorney, paid them $5,000, and in the end, all Mitch had was a denial, this time with an explanation.
That you have to have a 24-hour nurse on staff. This is a useless policy. He's never going to be able to collect on it.
Brad Hokinson enjoyed going to Gopher games with his dad, Stan.
It was sort of this guaranteed time that we could meet.
Sometimes Stan would bring up his will and insurance papers.
At the time when you're younger, let's say, a lot of it goes over your head and you go, well, that'll come up later, I don't have to worry about it.
When his dad died, Brad was the executor of the estate, handling everything he knew about. 10 years went by before Brad learned his dad's life insurance company owed him more than $10,000.
It could have been more dire situations for us financially, but that weight was something that was a little bit off-putting?
They have been holding on to a gold mine of money that really belongs to beneficiaries. It's unconscionable when an insurance company knows their policyholder has passed away, kept the money, and then used it for investment and not pay the beneficiaries the rightful money that they're owed.
In many cases, he says the beneficiary didn't know about the policy. The life insurance company had the name and contact information, but never contacted them, only paying out if a beneficiary filed a claim.
It's unfair, clearly. It's not their money, and so it's tantamount to theft in a way.
Now, are we talking about some of these recognizable names?
These are the largest brand name national insurance companies throughout the United States.
The state has settled with MetLife, John Hancock, Lincoln, Prudential, Transamerica, AXA, Jackson National, New York Life, and Voya. The Commerce Department found well over $200 million. So far, companies have paid $143 million to beneficiaries. Another $31 million ended up with the state as unclaimed property for relatives companies couldn't reach. Other insurance companies that owe money are pushing back.
They say, people haven't made claims.
So
Frances Haskins lost her cancer battle.
It was my grandmother from my father's side. Her name was, we called her Grandma Fran.
Her grandson, Kyle.
It was my
he got a call out of the blue.
I didn't find out about until 4 months ago.
His grandma listed Kyle as her life insurance beneficiary, meaning for a decade and a half, he's been owed more than $70,000. The insurance company never notified him.
I found out through private investigators.
43 other states has been auditing life insurance companies since 2008. Records show billions of dollars owed to beneficiaries. In some cases, the insurers kept paying their deceased clients' premiums. Imagine this hourglass as your life insurance balance. Instead of giving it to your beneficiary, the insurance company continues drawing from it to pay itself the monthly premiums, sometimes until it's all gone. Bill in the Senate requiring insurance companies to check the death master file at least annually and retroactively pay beneficiaries for deaths since 1992.
Unfortunately, life insurance is a business. Unfortunately, they're gonna make a lot of money.
A life lesson for Kyle Haskins long after his grandmother's life ended.
There are really only two kinds of life insurance: temporary coverage, which is called term insurance, and permanent insurance. Both term and permanent life insurance comes in various different shapes and flavors to satisfy different needs. Permanent life insurance is designed to provide coverage for as long as you live. If your needs are long-term, like estate planning or final expenses, or if you just want to leave a bigger legacy no matter when you die, permanent insurance is probably the way to go. There are lots of different kinds of permanent insurance, but the two primary categories are whole life and universal life. Universal life insurance, one kind of permanent life insurance, offers a certain amount of built-in flexibility. You have the ability to change your premiums and death benefits to keep pace with changes in your life. Whole life insurance is what I refer to as the Rolls-Royce of life insurance. Whole life costs more than all the other types of life insurance we've discussed, but it does more. Over time, these policies develop significant cash values that are guaranteed and can be accessed at any time. Regardless of what happens in the economy, each year the cash values grow. Guaranteed.
Now, there are some things that you can do as an insurer that can help make sure that the death benefit does get claimed. Review the insurance application carefully when you apply for insurance and be honest. Do not withhold any information even though you think it is not pertinent. Pay the premium on time, and a lot of companies will actually ask you to give another individual's name where they can send a premium notice to if you don't pay the premium. Let's say you move to another state and you forget to notify the insurance company, for example. Also, if your policy is a group life insurance policy through your employer, make sure that it is still in force each year and that the employer hasn't changed the coverage, especially if the employer is paying for the coverage.
In theory, insurance is a beautiful idea. Everyone chips in a little money. When something bad happens to someone, that collective pot pays to help them recover. It's like an emergency fund, but for the entire community. Let's say we've got 10 people in our community. They all drive cars and pay for insurance. When someone has an accident, the insurance company has a bunch of money waiting for them. So far, so good. Sounds fair. But things get messy pretty quickly, because that insurance company is not a charity. It's not a government organization with the sole purpose of helping people. It's a for-profit business, which means they only make money when they don't pay you. Every claim that gets denied, delayed, or underpaid is pure profit. So their entire incentive structure is completely upside down. They're not in the business of doing good. They're in the business of making money. And they make the most amount of money when they don't have to pay you. Quite literally, a wolf in sheep's clothing. They wear a facade of safety and good intentions, while behind the scenes, they're one of the most profit-hungry and predatory industries in the entire world. So profit-hungry, in fact, that these days they're functioning more like hedge funds than safety nets.
Mistake number one is not buying enough coverage to replace your income. You need 10 to 12 times your annual income before taxes in life insurance coverage. That means if you make $40,000 a year, you need a policy worth at least 10 times that, so $400,000 in this case. But George, I've got life insurance through my job. Sorry guys, that's not going to cut it. You'll get 1 to 5 times your annual income at most through your employer. I'm not saying don't take it. If it's free, great. But like they say in Canada, that's just gravy on top of the icing on the cake. So you still need your own term life policy to take care of your family's future. And don't forget coverage for both spouses. I'm looking at you, stay-at-home parents. Think about all the hard work a stay-at-home parent does. Now add up what it would cost to hire people to do all that work. Then multiply that number by 10 to 12, and you'll see why you both need a policy. Mistake number 2 is waiting too long to get coverage. Well, let's face it, you're not getting any younger. If you are, though, tell us your secret to Benjamin Buttoning, as I like to call it. The simple truth is that life insurance premiums go up as you get older. So buying sooner rather than later to lock in a lower premium can save you a whole bunch of money. Plus, if you start having health issues, those premiums can skyrocket by the time you try to get coverage. Or worse, you could get denied for new coverage. Here's an example for you. If a man in his 30s buys a 20-year term life policy, it'll cost him around $63 a month. But if he waits until he's 42, that number jumps to $126 a month. That's double the cost. Number 3 is buying too short of a term. I'm all about saving money, but like buying underwear from a thrift store, gross, this isn't one of the times to be frugal. Here's my general rule of thumb. Base the length of your policy on when you think the last person who depends on your income will be independent.
I'm a strong person and I can go make more money, but the impact goes far beyond the dollar. The impact goes to humanity, it goes to trust, it goes to why? I don't understand. This man had so much. Why?
I trusted Sean. I really did trust him. He was a good friend, I thought.
At his sentencing, Sean Heffernan sat quietly next to the public defender as victim after victim took the stand and shared their stories. He was a licensed California insurance agent that many elderly San Diegans trusted with their money after attending his seminars. But more than a dozen people were scammed out of their savings. The prosecutor says Heffernan took more than $1 million from victims, promising investment returns, but instead spending it on himself, buying jewelry, rental properties, and even a Maserati. Part of his scheme, known as churning, included convincing victims to cash out their annuities. A team of Secret Service agents, attorneys from the DA's office, and investigators from the Department of Insurance made the bust. Heffernan recently pleaded guilty to 29 felony counts, including elder fraud and grand theft.